Morning, everyone. My name is Jonathan Kahns. This morning I'll be talking about market indexes. More specifically, since market indexes are kind of broad, as you'll find out here in a moment, I took a focus on index investing. So let's start off with that. So just an introduction, a little bit of an overview of what I'll be talking about today, giving you an overview, kind of definition on what index funds are, how they work, index investing. As you can see, I'll have the 5 articles that I've talked about in my paper. We'll go through those and we'll finish it off with a conclusion. So a deeper look at index investing. So what is a market index? You probably know, you're thinking the S&P, the NASDAQ, the Dow Jones. So essentially indexes are a bundle of stocks that represent different sectors of the market. Now, they have different weighting techniques such as average price weighting or market capitalization weighting, which take the average of those stocks based on those price weighting methods or those weighting techniques, and that's what gives you your actual index. Those index values are actually associated with points. So when you hear someone talking on Bloomberg and they talk about, well, the Dow fell 30 points today, that's what they're talking about. So the fee structure and benefits we'll get to later. Those are one of the benefits of index investing, or indexes in general. It's very much a passive investment. So looking at some of the more popular indexes, we have the Dow Jones Industrial Average, which has 30 bellwether stocks spread out through companies in different sectors and industries. That's traded on the New York Stock Exchange and the NASDAQ. We have the S&P 500, which is Standard & Poor's, 500 large cap companies. The NASDAQ Composite looks at over about 4,400 different publicly traded companies across the country. And then you have the Wilshire 5000, which is basically also known as the total market index. I believe it has now over 6,000 different stocks, but they're all United States based. They're all publicly traded within the country as well. And lastly, we have a Barclays Capital U.S. Aggregate Bond Index, so that tracks T-bills, corporate bonds, government bonds. And the incredible part about indexes in general is that those are just some of the main indexes, but there's actually almost an infinite amount of indexes that can be made. Like I said, it's a bundle. It's used as a metric to track performance and financial health of different industries and sectors throughout the market. So looking at my first article, how index trading increases market vulnerability. Rodney Sullivan, his research paper looked at how diversifying portfolios has actually declined in the last 2 decades. One thing he found was that as thousands of new ETFs and securities and possible stocks are entering the market, more and more people are actually diversifying less. And with less diversified portfolios, people are actually investing more into index funds, which are passively managed. And with that, with the substantial index growth, I'll get some statistics up here in a second on one of my other articles, this increases market vulnerability. So with less people diversifying their portfolios, with the larger growth of new and entering stocks into the market, like I said, it's creating a riskier market, and it's impossible to just kind of sit by and not diversify and trying to mitigate that risk. Moving on to Article 2, how high-frequency trading affects market indexes. Dror Kennett looked at high-frequency trading, which, if you're not familiar, is actually quite fascinating. Companies spend billions of dollars on this just to install fiber optic cables in the ground for thousands of miles to get stock information and trades to travel at millisecond speeds, even centisecond speeds. And what he looked at was how there's a relationship between market indexes and their constituent stocks, so the stocks that are actually within those market indexes. And what he found was, in a small study on a shorter time horizon, what they looked at was low to medium frequency data. And what they did is they sent high frequency price movements from the data with several stocks through their study. And what they found was they found that indexes have what's called a leveraging effect on some of their stocks, which is actually kind of contradicting because it's the stock that impacts the index. And what they found was with the high-speed movement of these price movements and the information with these stocks, news is now traveling faster. So with the impact of news traveling faster, index traders are able to modify the average weighted price of their index, which in turn that news travels back to other companies, their stock prices change, and it creates a vicious cycle. So what he worries about is the fact that it's not so much a worry, but what he's trying to prove is that stock price movement actually has an impact on index values in general, but more so high frequency trading is the root cause of that. So news of a stock essentially can impact an index, travels on a faster time horizon. Index trading actually travels on a much longer time horizon, about several seconds, whereas you're looking at those millisecond speeds. What's incredible is how fast this has evolved. In the 1990s, we were looking at 7 to 10 seconds to execute a trade, and now Wall Street traders are able to do dozens of trades before you can blink your eye. So moving on, and if you haven't noticed, these all kind of interlock. So we're looking at how price movements within indexes work, how vulnerability within the market is increased by not diversifying, by diversifying, and some of those points will make a little bit more sense with these next few articles. So our index fund's evil. This was a rather interesting article by Frank Partnoy. He looked at the argument that index funds and stockholder diversification, which we just touched on in our first article, or the lack thereof of diversification, is actually strangling the economy. So what we found was that stockholders diversifying, but in a way that could actually hurt the market. And what he found was, in looking at a study done in the 1980s, I don't recall if it was his or if it was one that he was reading on, he looked at a study done on airplanes. And he found that common ownership within indexes can actually hurt the prices of other stocks and other common goods. So what he looked at was common ownership of airlines. So he looked at indexes that tracked specific airlines throughout the country, and he found that when dozens of different airline companies were within a portfolio and common ownership had spread wide across the economy, what had actually happened was he either found that collusion or the widespread growth and ownership of those stocks had actually driven up prices. And that was something that, aside from regular competition, that he found was an issue. So we also looked at Jose Azar's research. He's an advocate in the early to late 2010s, who's actually tried to become an advocate for reducing this common ownership amongst indexes, but his work has yet to gain any real traction, which has been sort of a problem. Frank Partnoy just took sort of an investigative approach and looked at common ownership within the same sector. So ultimately what he's arguing is that common ownership amongst, whether it's grocery stores or clothing brands, things of that nature, could actually be bad for the economy. Article 4, the growing peril of index funds, too much technology. As we all know, we've grown up in the technology age. It consumes our lives, and it's actually about 23% of the current S&P index as of December 26th, which is a substantial amount considering what we say the S&P was. 500, so we're looking at well over 100 different stocks. So the issue that he found is that, again, with common ownership, with 23% of the S&P being technology stocks, heavy weighting can actually overvalue these indexes and almost create a bubble. So he worries that with people creating their indexes and putting too much technology stocks in there, that although technology stocks are doing well, this bubble or overvaluing of indexes could actually hurt them in the long run. And one thing that should be noted about index funds is that you're not actually buying the S&P. You're not buying a share of the S&P. When you go to a broker or a manager, what they're doing is they're replicating that index. They're creating the same index with their purchase of all those stocks. One of the benefits of those index traders or those managers is that their fees are a lot cheaper, more inexpensive than mutual funds. As I mentioned earlier, it's passively managed, so you're able to kind of sit there and watch as these metrics track. But as we'll get to in a second, from an investing standpoint, you're passively watching your investments grow or decline. but from a management standpoint, it's a lot less passive. So the growing peril of index funds, like I said, too much technology. What he recommends is that people actually retract, try and take these positions out of their portfolios, sell, reap the benefits of them, and try and diversify their portfolios a lot more. So as we've kind of seen so far, we have this back and forth trend of diversification, not diversifying, and how it kind of impacts index funds in the market in general. My last article is investing in index funds is no longer passive, one of the points I just touched on in my previous article. So Danny Burgers looks at, her article in Bloomberg looks at how managers and investors are no longer passively investing in index funds. And what she gets at is the fact that there are now, I think it was well over 20,000 possible stocks to invest in. Forget the number she looked at. It was a Bernstein analysis that she had done the numbers on. But more importantly, when you take a combination, just like the possible combinations or outcomes on a Rubik's Cube or flipping a coin, the numbers can vary from 1 to 2 all the way up to trillions and trillions and trillions. And the number was actually close to infinite with index investing in terms of index funds and possible indexes and metrics that could be used to track the market. And what we're finding is that managers are now using other indexes as benchmarks and creating their own, a lot more diversified in terms of what they're looking at. So you might have a healthcare and an industrial index that's merged into one and used against 4 others as a benchmark, which can get a little bit tricky. And from a management's perspective, that's not going to be a very passive investment for you. You're going to have to pay attention to what your client wants, not only what they want, but what's best for them in terms of creating an index. You're not just replicating indexes anymore. You're specifically manufacturing and creating them for the client as well. So essentially, one of the things he said was no one can passively sit by with so much volatility and diversity in the markets today. And I think that goes for both managers and investors. If you want to sit back and watch a long-term investment like an index fund grow, you can certainly do that. I think you need to be a lot more active in terms of how you diversify your portfolios. Some long-term investments like this you could probably be passive with, but from a management perspective, it's certainly active. Jonathan Kahn's conclusion: I think you should invest in index funds. In terms of larger index funds, I think it's a solid long-term investment. I know I was just speaking with my brother, like his 401k is matched against the Dow, so how the Dow performs is usually ties into how his company deals with their investments in 401ks. I certainly think in the long run, index investing could be a profitable investment if you're looking to be a little bit more active and to take a little bit more responsibility. You can certainly create your own indexes with a manager or some sort of firm. But overall, I think index investing would be a profitable investment for any of us. Thank you.